We have Rohit Srivastava joining us this morning. Rohit Srivastava, good morning. Pleasure having you here with us. Just help us understand, what are you seeing on the board and why so much negativity as far as Indian markets are concerned?
See, the overhang of a trade deal continues to remain. I think at each step of the way, we keep looking whether we are past, out of the woods or not.
Okay.
So while various measures by the government have already taken place and the impact of that will be seen in this quarter's earnings, getting away with that uncertainty would be the big fillip. If you actually see how some of the other markets behaved, like Japan, for example, which is close to, has been making new all-time highs almost every other day.
Yeah.
It took off right after their trade deal got through, and we've seen similar action in several other Asian markets. So I think it's the same for India. We are on the edge of breaking past to new all-time highs, but deal announcement would really be the deal breaker for the market as well.
Right. So deal announcement seems long pending and fairly evasive, and many believe that it's going to be after the Bihar elections that perhaps the deal in whatever form could be announced. But meanwhile, looking at the charts again, I'm looking at the IT sector right now as we speak, and the IT sector not taking any positive cues from the US Fed's 25 basis point rate cut. I understand that perhaps that rate cut was factored in, but a negative movement seems a little difficult to fathom at this point.
See, the IT sector has many other headwinds, I think, beyond just the US trade deal. Because they've already, I think, spoken about, and we already know what the H-1B visa status is. So I think that's not the big issue.
Okay.
The IT sector itself is growing at a much slower pace than many other sectors in the market. So when I take a 1 year or 2 year view, it's not the place where I'm going to be doing my biggest allocation. It's going to be a place where you're going to actually go significantly underweight or potentially not own. If you can, if you have a concentrated portfolio, you probably not own IT stocks. It's only the diversified portfolios that have to have some weightage that might end up having some IT exposure. So essentially the growth and the momentum is somewhere else, and that is why I think the IT sector, apart from the bump up that it got from something like an oversold reading, we are not really seeing that much action.
All right. I want to also shift focus to the non-energy mineral space, and that is also something which I think becomes absolutely central today with President Donald Trump's meeting with Chinese President Xi Jinping, and the export control on rare earth minerals likely to get eased. At least that is what the expectation of the US is. But the Indian minerals then not really reacting favorably, perhaps losing that little bit of edge which they may have had given the fact that China had controlled its exports.
See, Indians metal sectors benefited a lot from domestic demand and from the weak currency. So it's actually outperformed the US metal sector as well. In fact, the last 1 week or even 1 month, it's among the top performing sectors. So I don't think that really changes with a one-day movement. I think the metal sector will remain in focus, especially given that the US policy is towards lower interest rates, even whatever near-term doubts may remain. Do remember that Powell is going to be moving out, and there'll be a more dovish Fed coming in sometime early 2026, and that will keep the momentum in terms of lower rate expectations. So why is that important? Because for the metal sector, a weak dollar essentially means higher commodity prices, and that is the bet, apart from domestic demand picking up.
All right.
So I think metals will remain in focus. They've done well, and they'll probably continue to do well. Apart from any knee-jerk reaction we are seeing today is only to yesterday's, not the rate announcement, but the idea that the Fed didn't sound so dovish about the next meeting. But I think the direction is pretty much set.
All right. I'm also looking at the FMCG space, Rohit, and ITC, of course, due to announce its results today. But investors taking some safe positions in that stock this morning. ITC is down about more than 0.8% or so in the red right now. And even HUL down about a quarter of a percentage point. Is this in anticipation of results not being in line with expectations?
So FMCG is a tricky sector because on the one side, they do have some growth. And it's a defensive. So as and when the markets go through a troubled phase, we do see buying coming in here. But is that the best place to be? So again, if I take the same analogy, what is the 1 month performance of the FMCG sector? It's actually not in the top 10 sector list, and that means that it's been lagging behind. And there are other parts of the consumer durables and consumption areas that have done better, specifically autos as such. So, do you really want to own, from a long-term perspective, do you want to own a lot of FMCG? My sense is this is a time to be in growth and not a time to be defensive, which is why first I mentioned IT, then it is FMCG, and even pharma. You'll have to be very, very selective between what is growth and what is not growth. So selective ownership of these sectors, but broadly these sectors would underperform on a 1 year, 2 year basis when growth outperforms.
All right. And finally, the pharma sector, Rohit, I'd love to get your view on that, especially Dr. Reddy's, which is down more than 4% or so, in fact, inching towards that negative 5%. And this, of course, coming on account of that non-compliance from the Pharmaceutical Drugs Directorate in Canada for one of its injection variants. A big deal for Dr. Reddy's and for its investors. I mean, compliance issues are one thing, but approvals often do take time to come. So, a great deal of negativity on that stock. Was that something that any investor would have expected to not come through?
Yeah, that's a hard call because you can't really anticipate some of these moves, and but they keep coming, especially for all the
I think
manufacturers
approvals.
that are exporting.
Yeah, but I
Yeah.
think it's part of the business, right? You will get approvals, you will get delayed approvals. Sometimes you'll not get approvals. It's all part of the process, isn't it?
Yeah, it is. But the issue is that you end up holding the stock for a very long period of time to actually watch it break even and for the news flow to turn positive. So it's more the time element that eats you up when it comes to these stocks, and which is why their returns have been slow and steady, not exactly accelerated if you look at any of these companies.
Right. Is that the similar sentiment playing out even on Sun Pharma, because even that stock is down today, or is this again more to do with trade deal with the US and potentially the APIs, etc., getting exported from China to US? Is that something which is weighing down on the pharma sector as well?
Yeah, no, I think it's just a common feeler towards pharma that we've had because of the combined issues, trade deal, of course, being one of them, as you mentioned. Uh, so that again, I mean, see that's where the entire focus then shifts away from these segments towards what is working. Metals is one of them that we spoke of, and if we just look at the where the performance has been over the last 1 month, it's been in yeah, even the banking space. It's been in PSU banks. It's been in mid and small caps that have recently again picked up momentum. So these are the segments that are doing well. Individual stocks, certain sectors, and we need to continue to keep our focus there and not go too much into the defensive space.
All right. And finally, I want to just pivot away from the Indian markets for a moment, Rohit, and get your view on this sort of, narrative which has been building over the last few months, that it might be a good time to allocate a little bit of your corpus towards US equities, US stocks. And we've seen the kind of rally in the Magnificent Seven. In fact, yesterday, Nvidia became the first company ever to breach that $5 trillion valuation. So, for those who have not yet dabbled into US markets, is it too late already? Have they missed the bus, or do you think there is more growth to come by way of all that we are seeing, President Donald Trump do, and this wave of AI, which is unlikely to ebb out anytime soon?
So the US is a very fractured market. If you're buying individual stocks in the US, you're right that AI is where the action is. It's in the top 10 stocks. Many of the others are falling by the wayside. If I simply look at a chart of the number of stocks above the 50-day average,
Yeah.
over the last 3 months, that chart keeps declining on the way down. And that shows that there are fewer and fewer stocks participating on the way up. Having said that, I don't think it's really over. There are several reports that show, if you look at Nvidia's price earnings ratios, it's in the 20s, which is not exactly very, very overvalued given it's the highest growing company.
That's right.
So in that sense, it's not like it's not very, very expensive in some parts of the market. The growth is there. So it's not over, but here's an important highlight, and I think very few people look at this, that when we look at the emerging markets index relative to the US market, we've actually seen the emerging markets index and the Asia index performing pretty well and starting to outperform over the last 1 to 2 months. So that's an interesting changing trend. We want to watch that a little more. And I think India, because India is lagging behind because of the trade deal, that is why we come up with this argument of US versus India. But emerging markets have already started to turn in terms of performance relative to the US. I think it's only a matter of time that India joins in and starts doing that. So don't, completely get over-focused on the US, missing out on what is still the highest growing market in the world.
All right. And final question before I let you go, Rohit. The Indian market, with the sort of time correction we've seen over the last 1 year, are valuations now a lot more believable and a little more realistic as compared to the kind of bull run driven valuations that we saw last year?
In many individual growth stock, the answer is yes. I mean, some of them where PE ratios had gone to 150, they've come back to a 50, 50s have come back to the 20s. So that has happened in areas of growth.
Okay.
But when we actually look at it at an index level, the valuation has remained, sorry, sort of constant. So in the 20 to 23 range as far as the Nifty is concerned. So Nifty is really not galloping faster than the rate of growth of earnings. That is what is actually happening. And that's because the earnings slowed down, and that was probably what the market was expecting. But it has also not given up on that valuation, which means it does expect the growth to come back. On the earlier US-India argument, I just want to add one more thing, and that is the hottest asset right now for some time had been, precious metals. So the real question that we face with is, do you continue to have a precious metals exposure relative to equity? I think the last 1 year was a period where PMs actually outperformed equities. I think the next year you're actually going to see that shift away from PMs towards equity, and that is something also to keep in mind.
And is that again coming on the back of banks, especially central banks, going back to the US dollar, and hence the US dollar becomes more expensive compared to the Indian rupee?
We've seen that a bit, but the US dollar, if you're going to get lower rates, eventually the dollar is going to fall. So it is going to be pro gold and silver, but it's really got to do with the extremely overbought conditions that ended up happening in the precious metal space. So a lot of buying has happened, a lot of short squeezing happened, driving up prices very, very far. And historically, whenever that has happened, they have underperformed for the next 6 to 12 months. So that's the point to keep in mind. I don't think it's the end of the precious metals bull market, but they can easily go into a consolidation phase, just like equities did over the last 12 months. The next 12 months, you could see the precious metals actually consolidate. And at that point of time, you see, emerging markets do better.
All right, Rohit Srivastava, thank you so much for all those inputs on this entire chart that we are seeing and all the sectors there in India as well as abroad. Thank you so much for your time.